This is a continuous topic for the previous one, that is example for discount. So when the bonds are issued at discount, very simple, coupon rate and market yield rate or market rate. For example, the coupon rate is in this example a 6% bonds. The coupon rate is 6%, means the bond will gives you 6% return per annum, and the market yield rate is 8%. So this is the market yield rate, 8%. So if you have these two details, the market yield rate, currently the market opportunity earning rate in the market is 8%, whereas your company is paying you 6%. So there is an opportunity to earn more in the outside. That is the reason the 1000 rupees bond will be sold at discount. So when the coupon rate is higher than the market rate is lower, and the coupon rate is lower and the market rate is higher, and coupon rate is equal to market rate. The three options. So here coupon rate is lower, so this comes to second category. So if your market rate is higher than your coupon rate, means you are having an opportunity to earn more instead of investing in this company in bonds. So what will you say? You will say no for investing. Since the company says I will issue bonds at discount, so this comes to discount, and remaining this comes to premium. Means discounting means the 1000 rupees face value bond, 1000 rupees face value bond will be sold less than 1000, that is 900 maybe. Okay, so that is nothing but the discount. We are going to do problem on this aspect now. In this problem we have a coupon rate at 6% and market rate at 8%. So market rate is higher. So when the market rate is higher, then what you have to do? You are going for the discount. Market rate is 8%. So the bonds are issued at discount. So a 6% 1000 bond dated 1/1/2007 is issued on that date to yield market rate 8%, and the bond pays interest each year, each June 30th and December 31st. So 6% will be paid twice, means 3% on 30th June and 31st June, again 3%, and matures 4 years from issuance. So it is matured on 31st, the maturity date is 31st 12/2011. Okay, this is the maturity date, matures. So what is the present value of the bond? So the bond value currently equal to the bond value, present value is what? So very simple. So I'll write a timeline here for better understanding. This is the 0 year and this is the 4th year. 0 year and year 1, year 2, year 3 and year 4. So at the year 4 ending maturity, the bond value is $1000. They pay you $1000. That is the face value of the bond. So simply for calculation of present value, you have to take, please remember, for calculation of present value and discounting, you have to take at the rate of market rate, or say yield, that is 8% you have to deduct. Okay, so your R is equal to, for calculation of PV, your R is equal to 8%. Okay, and you are going to get for how many years? For 4 years, and the coupon is twice in a year, so this comes to 4%. Okay, because you are going to get for twice, So the twice R will be 4%. R is 4%. And N, how many number of years? Number of years are 4, but 8 periods. Total 8 periods. N is equal to 8. Interest is 4%. And the future value of the bond is 1000. Future value of the bond is 1000. And for calculation of PV, you can directly calculate with the financial calculator, but I will give you here formula. So the formula is nothing but go to present value, lump sum table, or say single table value, factor value. Okay, and discount it. Table value, take the table value and discount the $1000. Go and check the table value. Okay, the table value, present value, lump sum table, 8 periods, 4% is 0.73609. So let me show you the table. So present value of $1, this is the table, and this is a present value lump sum table, and go to period 8 and go to 4%. So 4% period 8 is 0.073069. Is this the table? Is this the table value? Yes, correct. This is the table value. Okay, right. So you have to multiply this table value with this 0.73069. So that is 730 730.69 is the present value of 1000. And one more thing, you are getting interest every 6 months. Okay, so you are getting here interest. How much? $30, and here again $30. This is June 30th, and this is the December 30th. Again June 30th, $30, and December 30th, $30. Again June $30, $30, and again $30. So total 1, 2, 3, 4, 5, 6, 7, 8 30s you are getting. So 8 30s are future values for you. So those are nothing but the annuities. Already we discussed these are annuities. So you have to check the present value. Further present value, you have to check annuity table. So then present value, annuity. And one more thing, you are getting at the end of the year, at the beginning of the year, you are not getting anything beginning. So you are getting everything at the end of the 6 months. So this is nothing but the annuity arrears, or say annuity or ordinary annuity. So ordinary annuity. So go to ordinary annuity table. Then the ordinary annuity table is here. So this is the annuity table, and this is the annuity table, present value annuity table, and this is the ordinary annuity table. Ordinary annuity table 4%, 8 years. Again 4%, 8 years says 0.67327. This is the present value of ordinary annuity. Then you take this value, present value of ordinary annuity, into 30. That is 30 into 6.73274. Then multiply. So see the calculator here, 6.73274 into $30. So how much? $201.9. Okay, then plus 201.9. Then you add the 730.69. Okay, so 932.67, approximately $933 is the present value. So two steps here you have to do. One is for ordinary annuity, another one is lump sum. So these two values, this is for $30 of amount, this is for $1000. So this is the lump sum amount, this is the ordinary annuity. So 8 30s you are getting, so don't multiply into 8 again, take only 30, that is ordinary annuity. You are doing 6.7 times again, instead of 8 times you are taking only 6.37 times, because 6.73 times, because you are discounting, you are getting the $30 after 4 years, after 3 years, after 2 years, and after 1 year. Okay, so that is yearly 60 you are getting, half yearly 30 you are getting. Those are future values. If you convert into present values, automatically that should be discounted. So any doubt? So this is the normal basic process of calculating present value of bond while discounting. So the journal entries for recording the bonds, normally at the time of issue of the bond, see what is happening, the entry to record the issuance of the bond. At the time of issuing, you are getting only present value, the cash amount of present value, cash only 933 you are getting. So this is your debit because cash is received. And you have to show liability of the bonds payable. Your total liability is, normally your total liability is full amount, that is $1,000, that is your credit because your liability is increasing. So debit is 933 and credit is 1000. That something is not matching in this entry. So that which side is lower? Debit side is lower. The debit side lower, how much? 67 rupees. That is your loss. Okay, that is your loss. That is discount on bonds. Okay, discount on bonds. The non-current liability section of the balance sheet immediately after issuance would disclose the net bond value. So your bond liability is 1000, but it is in future. This is the face value and the future value after 4 years. Then you have to show your net bonds liability. So non-current liability section shows like this. Total bonds payable is $1,000 less discount $67 and $933 is your net bonds payable. Okay, net bonds payable. Any doubt here? I'm going ahead. Okay, we are adjusting. And the next process is amortizing the bonds. So for amortization of the bonds, we have two methods. One is a straight line method, another one is effective interest rate method. This is most important. I am teaching now effective interest rate method. If you understand this concept, the straight line method is very easy. This method first computes the interest expenses based on the beginning book value of the bond. So what are the interest expenses? Interest expenses means very simple. Your loan liability, your company's bond liability is $933. Already we calculated. This is the present value of the bonds. Okay, so we have to pay interest on this, or $1,000. We have to pay actually $1,000 at the rate of 6%. So the coupon rate is 3%. We are paying $30 every 6 months. So, but if you calculate, if you do that, that is your bonds payment, that is interest payment. $30 is the interest payment. Okay, so now I am asking interest expenses. Interest expenses are different from the interest payment. So interest payment is your coupon payment. So coupon payment is $30. You know that $30 is your coupon payment. But interest expenses calculated on your net liability. Your net liability is what? Already we calculated that net bond liability is $933. So at the rate of market interest is how much? 8%. So we are calculating for every 6 months. Okay, we are calculating for every 6 months. This comes to 4%. So 933 into 4% by 100 is equal to 37. This is your interest expenses. These are the interest expenses. And you already calculated $30 is what? Your $30 is the interest payment. Okay, so your cash payment every 6 months. So Actually, how much you have to pay? 37. But how much you are paying? $30. $7 is what? You are saving, because you have to pay 39.33 if you go for the market or any bank loan. At 8% you have to pay on this value. But how much you are paying? Just 30. That is 1000 at the rate of 6%. Okay, so this is 4% per 6 months. You are paying 37. You have to pay 37 interest expenses, and you are paying 3%, that is 30. Any doubt? Payment. So $7 is what normally you are saving when compared to the market rate you are saying. So in the same way, you have to add this $7 every year, because but now you taken only 933, but in future you have to pay 1000. So that is the reason you add 7, then it becomes 940. Okay, actually this is the normal adjustment process. So now 940 is your net liability. 940 is your net liability. So any doubt? So this is nothing but the bond amortization. So for this very simple understanding journal entry, interest expenses how much? 37, already we calculated. Cash payment is how much? 30. Which side is lower? This side is lower. $7 you are writing again credit side. In the previous example, in the previous journal entry, you written debit side, discount on bonds. See, discount on bonds in this journal entry is how much? 67, that is debit side. Now $7 is your credit side. In this entry, $7 is credit side. What is debit side balance of the discount on bonds? 60, because debited 67 in the previous slide, and now $7 is credited. So net debit is 60. Net bonds liability, net bonds payable, net discount bonds on payable is 60. So like that, the bonds discount on bonds payable is reduces, and the loan liability is increases. This process is nothing but the bonds amortization process. Okay, hope you understand. We will do some problems here for better understanding. Let me go to the problems. Let us do the problem question number 4. Can you read this question? See, Web Corporation has outstanding 7% 10 years bond. $100,000 is the face value of the bond. The bonds was originally sold to yield 6% annual interest. Yield is 6% annual interest. Verb uses effective interest rate method to amortize the bond premium. On June 30th, 2004, the carrying amount of the outstanding bond was this. What amount of amortization premium on the bond should be web report 30th June 2005 balance sheet. Okay, once again you understand the problem please, then we will start the answering. Yes, in this problem we are issuing the bonds, the corporation issuing the bonds at discount or premium. Yes, correct, the corporate is issuing for premium, because the corporation is paying 7% interest, but the market yield is 6%. So the corporation is paying higher interest on the bonds. So the people are very much interested to buy the bonds. So automatically the demand is more. The corporate issue at higher price than the face value. So the face value is $100,000, and the issue price is issue at what, right? So $105 $105,000. So they are issuing it premium. So there is a premium on the bond instead of discount. In the previous example we studied the bonds are issued at discount, but the MR is lower. MR means, yeah, market rate is lower. Then again the company is using the effective interest method, the same method, but in the previous problem we discussed about the discount, but here now premium. Yes, for better understanding I am writing here timeline. So today issuing at premium. So the face value is after how many years? After 10 years is the face value. 10th year the face value will be 100,000. Even you paid more than 100,000, you will get only 100,000. Okay. Then the interest rate is market interest rate is 6%, but the coupon will be paid at the rate of 7%. Coupon will be paid at the rate of 7% per annum. So is it per annum? Yes, there is no coupon payment of 6 months like that. It is per annum. You will get an interest like this every year. At the end of the year, $70, $70, $70 interest you will get. Okay, and the face value you will get now. Okay, and you have to calculate the present value, but the question is asking different, not this present value. Let me check the question once again. Here you see that on 30th June 2004, the carrying value of the outstanding bonds, this is the carrying value at this time. For example, this you assume as a present value at 0 year. Okay, so that is 105,000 at this point of time. Okay, then when they are asking June 2004, this is 30th June, sorry, yes, 30th June 2004. You assume this date as 30th June 2004, 105,000. This is the present value, and they are asking us to report 30th June 2005 at this particular time. So after 1 year, 30th June 2005, after 1 year at this particular time, they are asking us to calculate the value of the bonds, means net bond liability. Okay, so what amount of the amortization premium? They are asking us what amount of the amortized premium, unamortized premium, sorry, what amount of unamortized premium on the bonds. Means the premium already $5,000. The premium already $5,000. Okay, so the difference in between these two is the $5,000 is the premium. Okay, and after 1 year the premium will be reduces. It is less than $5,000. Now they are asking us on this particular time. So the 30th June 2004, the premium is 5,000. They are asking us to calculate premium on 2005. 30th June. Okay, you start the calculation, please. Tell me the answer fast. Actually, this entire process is not required, but for better understanding, I have written like this. If you assume this process for better understanding, but we can do very simple manner also. I have a lot of techniques for simple manner. I'll give you in my live classes. If you subscribe my online classes, I'll teach you. But this lecture, I am revealing the secret here. The secret I am telling you. Don't worry here. Okay, let me tell you this simple method. So please first you take the coupon rate and market rate. The coupon rate is 7%, which is higher than the market rate, that is 6%. Interest payment is calculated coupon payment. So the coupon payment is 7% on 100,000, the face value 100,000, that will comes to 7,000. Okay, and again like that you take the market rate. The market rate is 6%. This is for your interest expenses. Interest expenses on how much? So that is 105,000 at the rate of how much? At the rate of 6%. That comes to 105, 6%, 105 into 6. That is 6,300. 6,300. So what is the difference? The difference is 700. So what is your previous premium? The premium is 5,000. 5,000 is the premium. So you deduct from the premium this 700, you will get the net premium of 4,300. The answer is C. So in this example, you are deducting from the premium. So your premium is amortized, your premium is discounting, your premium is reducing. Okay, your premium is reducing. Any doubt? Okay, please subscribe my online classes at dr.yugendhar@gmail.com or at yahoomail.com. Please contact me at this email for easy techniques and easy method for better passing in CPA and CFA. I'm having 10 years of experience in online classes. 10 years of experience in online classes. Compulsory, I will help to pass your CPA and CFA exams with 100% sure. Okay, happy to help you. Thank you.